Now let's start to look for the detailed transactions happened in August for making the different sofas. First transaction, the company purchased the mold materials on account that were directly shipped to their warehouse. Because for manufacturing industries, they need different type of raw materials to make the products. So raw material is an important current assets in manufacturing industries in their balance sheet. For this transaction, we increase the raw material account, the asset, by $50,000. So from your 231 asset increased by debit. But this purchase, the company didn't pay on the spot. They put on the account. Buy something, purchase something on account means you use accounts payables. So we increase the account payable, which is a current liability to match with the raw material purchase. So overall, the journal entry is increase asset, then increase the liabilities. So debit raw material 50,000 and credit accounts payable for $50,000. And you can use this journal entry for any for any other types of asset purchase. So asset purchase on account is you increase the purchase the assets, then normally we credit the account payable. Then second transaction, the companies paid, be careful, paid means is already paid as cash. And the month's utility bills, so that may include your water bills, electricity bills, or other utility bills, $6,000. The utilities are used by all of the departments and the functions of the company. So this has a breakdown of between the admin offices and factory settings. Because later in chapter 1, we will learn we need to separate or differentiate the manufacturer-related cost and non-manufacturer-related cost. So the breakdown between the admin and the factory is approximate 30% and 70%. That's may depending on the maybe like the square feet of the office, right? Like the space they occupied or some other measurements. But anyway, it's given. So 30% goes to the admin and 70% of the $6,000 will be captured by the factory expenses. So there are two debit accounts. The utility expense for admin function will be recorded under the utility expense. This one is not matching with the products, so is a direct expense we can deduct in the income statement from the sales revenue later, so 1,800. But 70% of the factory utilities, they are related to making the sofas and other furniture. So they will be captured by another separate account we call manufacture overhead. So manufacture overhead is a expense or cost account, but is not a admin or sales related, is a factory overhead. We'll explain in more details of this account in chapter 1 and chapter 2. At this point of time, just to have an idea, or is represent the indirect manufacturer cost, because this utility helps for all of the products, not as your raw material or labor. You can identify for different products. This is a general manufacturer cost or overhead. So 4,200 will be increasing the manufacturer overhead, and overall we credit the cash. Cash is a asset decreased by credit, and the cost account increased by debit. So two cost and expenses account one related to the admin function and the other one related to the manufacturer function. So there is a breakdown. And the number 3 is a very critical transaction. We accumulated capture all of the cost to make the leather sofa and then complete in August. So let's first see the inputs. So those are the actual costs incurred in August to make the leather sofas. So is cost total material 27,000 actual cost. Direct labors, direct labor means the labor cost directly working on making the products. So like the factory labors. So their cost is 15,000. And we intend to make 100 sofas. And also the indirect factory overhead may include the 4,200 in transaction number 2, but totally we assume all of the indirect overhead is $20,000. So direct material, direct labor, and the manufacturer overhead to make 100 leather sofas, and assume all of the 100 sofas are completed in the end of the month. For this indirect overhead, because we have two product lines, the leather sofa and fabric. The leather sofa takes 60% of the overall overhead based upon the production volume, right? So the more products you make, the more factory overhead, right? So this is a breakdown of the overhead based upon the production volume. 60% goes to the leather and 40% will go to the fabric sofas. So let's focus on the 60% here for the leather sofa. So what is the total cost to make the 100 leather sofa and the unit cost? Also, in the meantime, we needed to make the journal entries to reflect the overhead, like the overall manufacturer cost, and then transferring the products to the warehouse. So first, let's see the calculation. The total manufacturer cost include 3 components. We'll get this into more, we'll emphasize, you will see this again in chapter 1. At this point of time, okay, there is no pressure to memorize, just to try to understand. You will have more opportunities to learn and practice in chapter 1. This is the introduction case. So the total manufacturer cost includes direct material, labor, and overhead. So it's 27,000 plus 15,000 labor and 60% of the overhead, which is 12,000. So totally you got 54,000. Okay, so if you want me to label that, so that will be 27K, 15K, and 12K. So 54,000. Then the unit cost, we divide the total cost by the units completed. So $540 per unit. I intentionally make the number small and easy to calculate. If you break down the unit cost into material, labor, and overhead, right? So like that's easily corresponding to the total cost. And remember, these are the actual costs to make the leather sofas. Later, we can compare the actual cost with the standard, the benchmark, to have an idea, have we go over the standard or under the standard, and we can analyze the differences. So these are the cost calculations. So the managerial accounting will prepare reports for the completed products, which we are not really offering the reports here, just to do the brief calculations. And this cost calculation, we only give the information to the internal managers. These are private information. Those are not for external users. So corresponding to the discussion we have in the beginning, financial accounting accommodate external users and managerial accounting satisfy the information needs of internal managers. So private information. Now let's see the journal entries to reflect the cost accumulation and the transferring the finished products. The cost accumulation, all of the product cost will be captured by the working process account. This is a current assets account, and you can tell the meaning by the name working in process. So it captures all of the cost inputs, but not guaranteeing all of the cost inputted will be completed, right? So like capture the started units or the started production. And in our case, everything is complete, but not for all of the actual cases. So it will capture all of the raw material use. So I increase the work in process, then decrease the raw material assets. And then I assume we have the wages payable or salary payable for the labor cost unpaid. So accrued labor expenses. And then credits the manufacture overhead. So when the manufacture overhead incurred, we debit, and now is allocated or moved to the working process. Okay. So 12,000. So totally is 54,000 total manufacture cost incurred, and increase the working process. Again, okay, if you still have questions, you are not fully understanding, no worries. Again, this is only a intro, just to get some of the general idea. We'll get all of the details later in chapter 1 and chapter 2. So total cost, 54,000. And then later, in the end of the month, all of the 100 sofas are completed and transferred to the finished goods. So if you can recall from the cost flow we have in this picture. So working process capture the inputs, all of the cost inputs from the beginning, we input. And once they are completed, finished, and they will be transferred to the finished good warehouse, either another inventory account. So when we transfer the finished products, we increase the finished good inventory by debit and credit the working process by the total cost 54,000. If in other case you didn't finish all of the 100 units, we only transfer the cost of the completed, or is something smaller than the 54,000. So, and this cost we call cost of goods manufactured. So in transaction 3, we have 2 separate activities and journal entries. One journal entry capture all of the cost inputs, and then the other journal entry capture the completed products into the finished goods. In our case, we are assuming all of the products are finished, but in regular cases, it may not be the case. But here, for simplify, we make all inputs are completed. And then continuously, number 4. So we complete 100, but sold 80 of the leather sofas to a customer on account. And the unit sales price is $700, so slightly higher than the normal sales price. So now we can tell the cost of goods sold. 80 units and times the 540, the unit product cost. So the cost of goods sold is $43,200. be careful, this is the cost for the units sold. And the sales revenue is 700 times 80. And this journal entry should be similar to the one we made for merchandising companies. When we sell products, we need two journal entries. One journal entry recognizes the sales revenue, and the other journal entry recognizes the cost of goods sold. You couldn't make a combo journal entry. Okay, be careful. We need two journal entries, one for the sales revenue. And here we sell to the customer on account means no cash is received. So sell something on account, we need to use accounts receivable, the current asset, and credit sales revenue. Asset increase and sales revenue increase, one debit and one credit by 56,000. Then recognize the cost of goods sold, so 43,200. And this increase of the cost is corresponding or matching with a decrease on the finished goods. In merchandising, I believe you credit merchandise inventory because merchandising companies, they buy and sell. They don't make the products. For manufacturer, they make their own products. So it's coming from the finished goods. So increase cost by debit, credit a asset by credit for the cost, and you can tell the gross profit. So the gross profit here, what is gross profit? That equals to the sales revenue minus the cost of goods sold before deducting other expenses. So for this sales transaction, we have the 56,000 sales revenue minus the cost, and you got $12,800, right, for gross profit. Before you considering any other operating expenses. So the direct profit we earned from selling the 80 units of the leather sofas is 12,800. And then finally, number 5, let's do a small summary for the transactions in August by summarizing the income statement. We already recognize, we know the revenue and the cost for selling the leather sofas. Then the fabric sofa information is directly given here. So we made a sales revenue for 42,000, but the total cost is 44,000. So what's happening here? The fabric sofa is not doing well. So we have to lower the cost like below the price, right? So you have to give a deep sale so we can market the fabric sofas. So you are losing money basically by the fabric line of the sofas. And because I intentionally make the question like this, because later we want to have a question. Okay, if you see losses for a product line, should we discontinue? Or should we discontinue the fabric sofa? So since we are losing money here, so we'll discuss this later. But so far, we summarize the income statement for the two products. I have the leather and the fabric, right? So separate information, sales revenue, and visitor cost of goods sold. And the company-wide, combining them together, we have a middle gross profit. And then the overall operating expense, like other operating expenses, such as your marketing expenses, admin expenses, so non-manufacturer. So let me summarize. So this means your non-manufacturer expense. So it's given by the question 6,800. So we can also make a combo journal entry for this 6,800. So I'm skipping that. So just to focus on the calculation of the net operating income. So in this case, it's 4,000 before considering any income tax effect. So we only have this 5 transactions. But from these 5 transactions, I want to have a overview for how to make journal entries. So I'm not review all of the debit or credit, the double entry system, but focus on the transactions we have here. And more important, let's differentiate. Okay, by making the journal entry, capture all of the transactions, we can provide the financial statements. If we have some other background information, we can make the balance sheet or cash flow statement. But also, we summarized some of the managerial accounting information. For example, the total cost to make the products, unit cost to make the products, and the cost of goods sold, cost of goods manufactured. These detailed information are only available for internal managers to use. And then they can use all of this information for other type of managerial accounting analysis, and then help them to make related decisions. So for financial accounting, you are pretty much done once we finish the financial statements, right? And then I do offer a few discussion questions related to the managerial accounting, and we'll discuss in the next video lecture.